Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on this podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning for your eventual exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. We want to help you build a business that's growing in value, but we also want to help you protect the value of your business. And one way to do that is through careful and thoughtful tax planning. Tax planning as you're growing and building the business, but then also planning that will minimize taxes when you eventually sell or transfer the business. And too often at sale, owners are sadly surprised with how much of their sale proceeds are going to go to both federal and state income taxes. And so that's today's topic, minimizing taxes at sale with the Section 664 Business Owners Trust. And our expert guest today is Roger Silk, PhD. He's the founder and CEO of Sterling Foundation Management. Roger is widely recognized as a leading expert in the field of private foundations and charitable trust, and a founder and board member of several nonprofit organizations. Dr. Silk earned his PhD and an MA in applied economics from Stanford University, as well as a BA in economics with distinction. He was awarded the esteemed CFA, Chartered Financial Analyst designation by the Association of Investment Management and Research, and is the author, along with James Lintott, of creating a private foundation and then managing foundations and charitable trust. He's both a speaker and an author, with articles appearing in various estate planning, philanthropic, and wealth management publications. He's also authored two important studies pertaining to or relating to the optimal use of charitable vehicles in various tax planning contexts. And that's what we want to focus on today, a vehicle that can minimize your taxes and help you to accomplish all of your goals, which are foundational to any holistic exit planning process when you're selling your business. So please, Roger, thank you for joining us this morning. It's great to have you with us.
Well, thanks for having me, Pat. I really appreciate it.
Hey, Roger, let me get started by just asking you a question. What's your normal client look like, if there is such a thing?
Yeah, Walter, before I answer that question, I just wanted to make a disclaimer here that we do not provide tax or legal advice, and nothing that we say should be taken as tax or legal advice, and everybody who has those questions should consult with their own tax or legal expert. Okay, having said that, Walter, we tend to work actually across a very wide range of business owners, as you might measure that, say, by the value of the business or net worth of the client. By count, the largest number of the people we work with are probably in the million to 25 million range. But we have clients all the way up to billionaires. And in fact, one of the tagline on some of our stuff is billionaire solutions tailored for millionaires. And that kind of alludes to the idea that some of the stuff that we do is very sophisticated, and we are able, because of some of our higher end clients, to spend really significant, huge amounts of time, and I might add money, figuring out solutions that then work for people with maybe a couple of zeros fewer on the numbers that they're talking about.
Yeah, that makes sense. So, one of the interesting things when you're talking to a business owner and you're asking them, just the classic, how much do you think your business is worth? And let's say they answer 10 million. In their mind, they're thinking they're going to sell their business and walk away with $10 million often. So, you know, lots of small things eat into that, like transaction costs and things like that. But the big hit is taxes. I mean, you know, we're looking anywhere from 25 to maybe 45% they're going to lose in taxes. So we're really excited to speak with you today because, first of all, you acknowledge that that's a serious problem for people. And then we'd love to hear your solution to help maybe solve that problem somewhat.
Well, that's a really common observation, Walter. I agree with you. Most, and I would say most, and I totally understand it, right? I'm a business owner. You guys are business owners. It's like it's not a happy sort of fact to acknowledge that we have this silent partner who thinks he owns somewhere between, as you say, 25 and 45% of our business. But when we go to sell it, that's the case. And it's right. It's the case for any appreciated asset that you might have. Yeah. We're talking about businesses here, but you know, somebody, I think they tend to be more emotionally involved with their business because, you know, people put their lives into building a business, and it's kind of a shock, as I'm sure you guys know, a lot of the time when they realize, oh, I don't actually have 10 million here. I can't put my hands on it. So when I sell it, you know, the Uncle Sam wants some. In most states, the governor wants some. And as you say, there's all these things. There are, as you guys know probably better than I do, several, at least theoretically possible actions that business owners can take prior to the sale of a business that can mitigate or minimize the tax hit when they sell. But as you've asked us, we have one particular solution, and I do not say that it fits. It's definitely not appropriate for every instance, but we have a solution that, when it works very well. We call it a Section 664 business owner trust. And the way it works is a properly structured trust that qualifies for tax exempt status under Section 664 of the Internal Revenue Code can be an excellent vehicle for a business owner who wants to exit, sell his or her business, and not pay tax. So I'm just take us a minute to kind of give you a high level overview of how that could work.
Great.
Let's say we have a business that's worth $10 million, and for simplicity's sake, let's just say there's zero basis. For simplicity's sake, let's say there's a single owner. Let's say it's an LLC. So that owner could create, we actually would do it for him, but or whoever would set up this qualifying Section 664 trust, transfer some or all. And it's a really important point. It's not all or nothing. Let's say that they think the business will sell for 10 million. And again, oversimplifying, suppose that's their entire net worth. So obviously you're not going to want to put the whole thing in a trust. At least most likely they're not. They say they want to keep 2 million. So they take 80% of the LLC units, transfer those into the trust, and then the business sells. Okay. And at that point, the business owner would have 2 million that's still in his or her taxable ownership. So they pay him tax on the 2 million, but the 8 million would sell and no tax. Okay, now there is $8 million of cash in this tax exempt trust, and the business owner or the business owner's wealth manager can then invest that almost any way that they want. There are some limitations, the main one being that they can't use leverage. They can't use margin. Let's say that it's a regular stock and bond account. They can't use margin. What does so now the question is, how does the business owner access the trust? So standard way that this is done is the business owner retains the right to receive 5% income from that trust every year. And that it can go, and so that income when it comes out is taxable, and it comes out as whatever it went in as. So in the example we just gave, it would be capital gain, assuming the business sold as cap gain. And so then when the trust makes payments out, those are going to be capital gain to the business owner. It can also go to a spouse. And what we typically see is the business owner and the spouse get that income for their life. And then after they pass away, it can go to a child or multiple children. And then often after that, it can go even to grandchildren. Can't last forever, but this type of trust, how long it lasts is determined by actuarial calculations that are made at the time that the trust is set up and funded. We typically see trust durations expected of about 50 to 60 years. Having kind of given that explanation, so what's the benefit of that? So the benefit is, the main benefit, the main driver for why most people do this is they don't want to pay, they want to avoid current tax on that. I'm going to go back to 10 million because we can all do math with 10 easier than with 8. Let's suppose we had the entire $10 million, and let's just, again, to keep the math easy, say the tax was 40%, which it can easily be if there's recapture and whatnot, which most businesses have some of that. So let's say that a super basic comparison would be the $10 million growing and earning income for 50 or 60 years is going to produce a tremendously much larger amount of net after-tax spendable for the business owner and his family than if everything is the same, except that they sold it and they paid tax and they had 6 million. And even if they were going to get 7 million, or the most that people can usually get is 75%, because if they're only paying the federal tax, that's about 23.8, 24%. But even when you have somebody, we did one recently, and the seller was in Florida, which doesn't have any state income tax, so they're looking only at cap gain and not very much recapture, so they're about 25%. And even in those circumstances, we see that the expected income over a long period of time, over the whole period of the trust, to the family, net spendable after tax is about twice what it would be with no planning.
But eventually the principal goes to a charity, correct?
Walter, that is exactly correct. Eventually it goes to a charity. That's what happens in 50 or 60 years. And the discussion that we most often have is that business owners would be interested in this, even if at the end of 50 or 60 years, that remaining value in the trust just disappeared in a puff of smoke. Because so the charitable piece is way out there, but most people view it as frosting, an extra bonus. And by that same token, in many of these cases, there's an upfront income tax deduction for maybe 10% of the value going into the trust. But again, it's not that income tax deduction that's driving it. That's more frosting.
Yeah. I've heard people even say, you could take that tax savings, buy an insurance policy, life insurance policy, and that can kind of replace some of the principal.
Sometimes that's right.
Yeah.
It's and that's a really important point, Walter. Typically, when you're selling a business, there's a lot of considerations. Taxes is a very important one, but it's not the only one. And there are liquidity issues. You may have a taxable estate that you need to worry about, which is obviously tax, but we were just talking about income tax. And so, I know that's what you guys do, a lot of the exit planning, to make sure that people take a look at everything. And so I do want to emphasize, this is a tool. It's a great solution when it works. It often does work, but it's not the only thing.
Mm-hmm.
And those proceeds in the trust, they're out of your estate also, right? Or
Well,
they're not, because you have an income interest.
That's right. So the way that another generally, when someone sets this up and they fund it, about 10% of that value is out of the estate, but without further planning, that remaining 90% is in the estate.
Okay.
And if you have taxable estates, or if a particular person has a taxable estate, this is a tool that can be used frequently in conjunction with other tools, because most taxable estates, they have appreciated property, and so you're facing an income tax problem and an estate tax problem. We're looking at one right now where they have essentially no basis. It's an operating business, and so their assets are arguably trade or business assets, which are subject to ordinary. They're in a high tax state, and they have no more tax exemption on their estate tax left. So,
wow. Challenging.
So you need more than one tool to handle a problem like that. I mean, without planning, I mean, it's almost unbelievable, but without good planning, those heirs are maybe looking at being able to put their hands on 10 to 20 cents on the dollar.
Wow.
And their parents worked their entire lives building this business. So that is so this would be one tool. This particular thing would not be, it's not common that you're going to only do one thing, right? I mean, people have multiple goals, people have multiple issues. But this tool is really powerful in the right situations.
So the 5% you threw out, is that a magic number? The IRS puts some type of range on that number, correct? Or no?
That is correct. So again, yes, that does come out of a statute. In theory, the number can be higher. Most good planning, if you're deferring, right? This doesn't completely avoid tax.
Yeah.
It defers it. And so most people, the planning makes sense. You want to provide for as much deferral as possible. So we tend to set it at 5. And the way that we usually structure it is in such a way that the investment professionals, by the way, we don't do investment stuff. We are not investment managers. We don't custody assets. So there would be either somebody else has to do that. We don't do it. And I understand you guys don't do it either. But we tend to structure these in such a way so that somebody, the right person, has the ability to defer in income payouts for no set period of time. So basically indefinitely. I mean, we've seen it as long as 20 plus years. it's another really valuable kind of flexibility of this kind of trust. So I'll give you an example just to explain what I'm talking about. So say we had that 10 million, 5% of that's 500,000. And let's say that the owner, I'm just gonna make it easy again, say they don't need any of that. They have other money outside and they don't need this money to spend. They're basically trying to invest it to build the family wealth. They see this as an inheritance asset and they want to be able to pass it along to their kids. So in the first year when that 500,000 could be paid out, but isn't, goes into an accumulation account. And let's say year two, it's another 500,000. And just again, to make life super easy and the math easier to follow, there's going to be compounding and growth. So, next year it's going to be a little bit more than 500, but I don't want to try to do that in my head, make the listeners try to follow that in their head. Let's just say it was 500,000 a year for 10 years. So after 10 years, there'd be 5 million in that accumulation account. And so that's 5 million of deferral. And I just ran this for an advisor yesterday. He has his client is looking at a sale we use a number 2.4. Obviously, you don't know what that number is until the business sells, but we use that number 2.4. And given this particular client situation, their ages, they're looking at, what he asked me to do was, if we defer for 15 years, which sort of is like the expected life of the couple, they don't need the money. They just want to treat it as an inheritance asset to build it for their kids, but they want the option. So I ran those numbers, and with deferring for those 15 years versus paying out and paying tax for those first 15 years, the total long-term expected cash flow to the family, which would be the kids and the grandkids in this case, because the parents weren't going to take any. The difference was 15 million versus 9.
Wow.
It's just huge. That's over 60 years or whatever it was,
yeah.
But it's just sort of the idea that I don't know how, most of the listeners to the podcast are probably somewhere kind of in our age range. They've been around for a while, because otherwise they probably wouldn't have a business that they're ready to sell. But if you can remember back to the way it was before interest rates were zero, the part of the wisdom of tax planning was deferral. If you can defer long enough, it's almost as good as not ever paying the tax.
Yeah.
And so, it's really remarkable when you have deferral over really long periods of time. You can get those big differences from seemingly small changes. Oh, I'm not going to take that income this year. I'll take it in the future year.
Yeah. So statutorily, is there a limit as to how long you can wait before the money ultimately goes to charity?
Well, you don't actually technically ever have to take it. We have on occasion seen clients who use this because they got a lot of wealth and they're not ready to actually give it away, but they think that they might. And so you could, in theory, just never take it, and eventually it would all go to charity. Never actually seen that happen, but it could.
But you couldn't. But there's a limit to how long the money can sit in this trust before.
Yeah, right.
And
that's oh, I see what you're saying. That's determined by actuarial calculations. So the inputs to those actuarial calculations are the ages of the trust beneficiaries at the time that the trust is funded, the applicable IRS tables in force, the numbers in the IRS actuarial tables that are in force at the time that the trust is funded, and the applicable interest rates at the time that the trust is funded.
And you couldn't, And do they kind of like with the IRA rules, if you have let's say you have a 110-year-old business owner who's got a 1-year-old great grandson, could he make him the beneficiary?
Well,
Or the IRS they stop that, right?
I've never seen one. So in that case, the answer is going to be no. You can't. I mean, it's not that they couldn't name that 1-year-old, but they couldn't name the 1-year-old for the 1-year-old's life.
Okay.
Right? They would be limited to a period. And typically, what we see, I've never seen that scenario. But what we typically see is there are kids, generation 2 and generation 3, and usually you can get the full life of generation 2. So you get the full life of generation 1, the full life of generation 2, and usually you don't get the full life of generation 3. You get some period of years.
I see. That makes sense.
Yeah, so Roger, just maybe a layman's question. When if somebody elects to defer taking any income and say they say, okay, I'm not going to take that 500K for the first 5 years, which equates to 2.5 million. Does their accessibility actually accrue, or is it if they defer taking it that they don't really have access to that 500K?
That's a good question.
So it goes into something we call it an accumulation account. I'm not sure if that's an actually official term.
Yeah.
But so we have to be careful about access. So you guys familiar with the concept of constructive receipt?
Mm-hmm.
So in case the listeners are not, and again, this is not legal or tax advice, but constructive receipt is a concept under which if you are eligible to say somebody owes you money, or you're eligible to receive money, and you can basically just reach out and take it. Most of the time, that even if you don't, if you could just stick your hand in and take it. That's called constructive receipt, and you can be taxed on it for income tax purposes, even if you didn't take it. So an example of that might be, and again, not legal or tax advice, but say your employer, or most of you people listening to this are going to be the employer themselves, but it's so in the case of a business, it's explicit, right? Even if your business earns money, if it's pass through, not a C corp, if it's a pass through, you're going to be taxed on that money, on that income, whether you take it out of the business or not, because you own the business, you could just take it. Your employee who might feel like he deserves a bonus, but you didn't determine to pay him a bonus, he doesn't get taxed unless he actually gets that bonus. Or if there were I don't want to get into that too, but so the constructive receipt concept can apply in this case. So we have to structure it in such a way, working with the advisors, that the business owner is not in constructive receipt of that 500,000 or that million or whatever it is, but somebody can have that. I mean, obviously somebody has to have the ability to distribute that, because the trust, when it actually, for distribution purposes, recognize that income, it has to distribute it to the business owner. So the short answer to your question is, Corby, yes, but it's not as simple as business owner sits there and writes a check to himself. That would be a bad circumstance.
Yeah. But it would seem that at times, as business owners sell, they think, okay, I'm going to get this huge check now, even though I haven't picked up my boat yet. I could go pick up my boat 2 years from now, and just the giving up access for a long-term purpose, probably passes through their mind. So
yeah, right, and so they're not necessarily what you're describing is very common. So an owner feels, and this is what Pat started with, or I think it was Pat, feels like he has $10 million because the business is worth $10 million. But it's sort of like, the old thing where the monkey has to put his hand inside and grab the nuts and then can't pull his hand back out.
Right.
You don't actually have that 10 million because the government says no, part of it's mine.
Yeah.
So one way or another, you have to accept the fact that you can't get your hands on the entire amount all at once.
Mhm.
And so this is a way of getting your hands on, in some cases, more than the entire amount, but over time.
Yeah.
Hey,
Yeah.
Roger, let me ask you two more questions. Sorry to be bombarding you. So one would be timing. I've worked with attorneys in these transactions where they basically take the position right up until the sale documents are signed. You can contribute your stock to the trust. Others are not that aggressive. Where do you fall on that?
So, the law says as long as there's no legally binding obligation. The issue that sometimes crops up is that there can be a gray area, right? That's why we have lawsuits sometimes. One party thought that they had the deal done and the other party didn't. So as you know, Walter, that's a very fact and circumstance specific case. So I'll tell you some examples where we won't do it, where escrow is supposed to close in 3 days and we're just waiting for the check to come.
Mm.
From the point of view, you guys have probably done enough of these deals. It ain't over till it's over, right?
Yeah.
But that would probably be too close to the line, even though, we all know it ain't over till it's over, right? It ain't over until the check clears.
Right.
But that's often a case. So the reality there is the lawyers involved in the deal will have a better idea of where that deal actually stands than we have. So, the ideal solution, Walter, is to get out in front of this, not to wait until you're way down the road.
Right.
We, for whatever reason, this seems to be a very common issue, and hopefully your listeners are more aware of the value to them of planning before they're way down the line. But I had a discussion yesterday with a lawyer in the New York area who does this all they do, and he says it's just astounding how frequently he won't even get the call from the client until, hey, I'm in escrow. What do I do? Can you help me with my planning?
Yeah. Scary.
So you really want to get out in front of it because there's lots of different things. It's not just, as I said earlier, right? There's all sorts of considerations that need to go into this exit planning.
This is fascinating. We could go on forever. And Pat, I think we need to get Roger back to follow up with some stuff. But let me ask one last question, and then we'll see if Pat and Corby have anything else. I always think of these as, the classic charitable remainder trusts. And when you use that phrase with a client, they automatically think, well, I don't want to give anything to charity. But I think what's fascinating is the way you present it, it's a tax strategy, and the charitable piece is not what's driving it. But do you believe that a client would probably most likely be interested only if they still have some level of charitable intent, or not necessarily?
So it's a funny, again, I'm not a lawyer, I don't do legal, but I think charitable intent is a legal concept. So let's set that to one side. Let's say that they aren't terribly motivated by it. They might tell you, and I'm sure you guys have heard this, my kids are my favorite charity. Obviously, kids are not technically a charity, but people, I would say 95% of the people who do these things, charity is way down the list of motivations.
That's interesting.
Yeah. So it's really, I mean, as a, you know, it has to be there. It has to qualify under 664. And if I recall correctly, there might be something about intent in there. I don't remember if there is or not, but it's, most of these are driven by financial calculations that don't put dollar value to the client on the money going to charity, if that makes any sense to you.
Mm-hmm. Mm-hmm.
That's really interesting. I think I've been guilty of knowing a client, because, you know, I'll do someone's tax return for years and they never give anything to charity. And then in my mind, I've always thought of these as charitable trusts, meaning that those clients not going to be interested. But yeah, this is really eye-opening for me. So I really appreciate this.
Yeah, and Walter, your observation again is dead on. It's been traditionally thought about, talked about, and marketed that way. And I think one of the reasons for that, I think, is just the traditional it's plan giving, right? Plan giving groups that at charitable organizations that are large enough to have them, you know, they're much more interested in the 75-year-old single guy who's got one foot in a banana peel, right? Than they are in somebody that wants to plan and I want my grandkids to get something out of this, because, you know, and we get that, right? If we were trying to raise money for charity, that would not be the first thing that we'd probably put out there.
Right. Yeah. Very interesting.
So Roger, thank you. You've been generous with your time today, and we'll wrap up here in a minute. But I wonder if you can answer one more question, and that is, talk about business structure and the ideal business structure that would work with this tool.
So I guess sort of the two easy, and I'm assuming that there are no sole proprietorships that are filing Schedule Cs that we're talking about here. So let's just set those aside.
Mm-hmm.
Partnerships and LLCs tend to be pretty straightforward. C corps are super straightforward. S corps are less straightforward. Doesn't mean that they can't be planned around. But again, it's very much of a detailed question when you have an S corp. And most businesses, it's obviously simpler when there's a single owner. When you have multiple owners, depending on the facts, a lot of times you can do a piece, like one owner can do it and the other doesn't have to. Or two owners can do it and a third doesn't have to. Again, if it's an S, that's more complicated because of some of the limitations built into S's. And again, you know, we can spend an hour on this question. At least.
And we made a commitment to you for a certain amount of time today, so thank you so much. This has been hugely helpful. We knew it would be, and you were a fantastic guest and great content. Yeah. Listeners, this is just one more example, and Roger, you actually mentioned it a few minutes ago, of why it's so important to get started early planning for your eventual exit. Because this is just one piece, tax planning. It's essential that you get started early and that you have a holistic approach to planning your exit. It's much more than just showing up at a deal table and signing transaction docs. So please, we beg you, get started early and take a holistic approach to it, comprehensive approach. Roger, thank you. Is there anything, Roger, that we like to ask our guests if there's anything they'd like to promote? Is there anything that comes to mind? A book, you're an author, anything that you'd like to promote today?
Oh, well, thank you so much, Pat. I just want to mention to your listeners that in addition to, so this kind of trust approach can also work, and we can help you with it if you have appreciated real estate And as you know, you can exchange that tax-free, but this is another tool, another arrow in the quiver for potential exit strategies from real estate. It can also work and works extremely well if people have a concentrated position in a stock that's gone up a lot and should be diversified. And we also have, we have solutions. I don't know how aware your listeners are about the Secure Acts, the quote unquote Secure Act death tax on retirement plans. If you have clients who have big IRAs or 401ks that they believe are going to be inheritance assets, the Secure Act, even if they don't have a taxable estate, the Secure Act effectively creates a death tax. We have a solution for that. And since you mentioned book, I have a book about inflation. It's called Politicians Spend, We Pay. I don't think I've talked to you guys about it, but if people are interested in inflation, they can contact us and or look for it on Amazon or our website. Can I give our website?
Yeah, and any way in which you would prefer listeners to contact you about any of these things that you've talked about today.
Yeah, best way to contact me probably is through my email, which is Roger, ROGER .silk, SILK, at sterlingfoundations.com. That's STERLINGFOUNDATIONS.com. People can also get a hold of us on the phone. Number is 703-437-9720.
Well, fantastic. Thank you again. And listeners, if you want help in building a transferable business or in taking a holistic approach to planning for your exit and you want to get started today, you can either reach Walter at 301-950-9090 and Corby and myself at 301-859-0860. So until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.